Okay, hello everybody. How you guys doing? Today we're going to be doing a class on uh, chapter 6, depending on what book you're in, but let's just go topics. We're going to be dealing with departmental costing and cost allocation. So again, departmental cost and cost allocation will be the focus of this unit. But what I want to focus for us here is cost allocation. I think I'm going to make a separate video just on departmentalization. So hang tight and we'll kind of go through the material. Let's see if you can, I hope you can see my Excel document here. Give me a second. Okay, so you should now see my Excel document, and I have here the topics that I want to cover with you guys. So I'm hoping to go over fixed and variable costs with you. This is a review of something we did in a previous video. We'll also talk a little bit about product versus period costs. And then I want to quickly get into absorption costing versus variable costing. By the way, another name for absorption costing, if you remember previous videos that I've done, this is external presentation. So external versus internal, another way of saying that is absorption versus variable. Another way that's common out there is actual costing versus normal costing. So these three basically mean the same thing, and these three things basically mean the same thing. Okay. Just so you have an idea. We'll also talk about cost pools. Another name for cost pool is a budgeted overhead amount. Cost drivers is another topic I want to talk about, and another name for that is budgeted volume. I want to show you how to calculate a overhead rate. I also want to show you how to calculate overhead applied, and I'll also do an example where you will see the calculation of a job cost. Okay, just to kind of give you some ideas here. So first off, a quick review about fixed versus variable. Remember, fixed deals with costs that have nothing to do with activity. So fixed are costs that have no connection to activity, whereas variable costs, they vary with level of activity. So I think in a previous example or previous video, I may have said like if you're being paid a commission, your employer treats that as a variable cost. The more you sell, the more of a commission you get that costs them money. So variable costing is as level of activities change, so does the cost, right? Fixed costs have nothing to do with level of activity. So no matter how many units you sell, your cost will remain the same. So a good example of a fixed cost would be like your rent. So no matter what's happening inside the building, your rent is the same. It's not dependent on that level of activity. So it's important to understand the difference between fixed and variable. When it comes to product versus period costs, sometimes people refer to product costs as manufacturing costs. Same thing. Manufacturing costs are typically made up of direct materials, direct labor, and overhead. So when you hear product costs, think manufacturing costs. What did it take to make this product? And what's involved in making a product? Well, you need the stuff, you need materials, you need people putting it together, and then you need a place to do it in where you need electricity. I always look up when I hear the word overhead, and the first thing I usually see is a light, right? So like that light that you see there, that's part of the overhead costs of running this household, gas and electric as an example. So material, labor, and overhead. Think of overhead costs as like the expenses involved in the production of whatever you're making. Okay, so you got your direct material, you got your labor, and then you got your overhead costs. So I don't know if you guys ever, for some of you in this class, maybe you've used an easy bake oven, or you've done creepy crawlers, or whatever the case may be, where you have this goop and you put it in like this mold metal tray, you pour it in, and then you slide it into some little machine with a 100 watt bulb, and it kind of hardens that substance, and boom, you either have some little food product, or you have like a little toy that you can play with, a little rubberized thing. If you got, at least they had that kind of stuff when I was little. I don't know. But anyways, I always like to use that as an example because it's like the perfect scenario of what is involved with manufacturing. So first off, you need the person, the direct labor. By definition, direct labor are the people's salaries that are on the assembly line. Okay? So the ones that are on the front lines, basically, the ones that are doing the stuff, right? The indirect labor is part of overhead. So think of overhead as indirect costs. Those would be the supervisors, the people behind the scenes, the ones that aren't actually getting their hands dirty. So if you think of a medical office, the doctor and the nurses are the ones who are part of that direct labor. The people that are in the office and billing and that sort of thing, they would be considered like indirect labor. They would be more overhead costs. But still, you got to take all of their salaries into account when figuring out how much is it costing us to serve patients, or if you're manufacturing, how much is it costing us to make this product. So product costs are also known as manufacturing costs. And what makes up these product costs? Material, labor, and overhead. Anything that is a direct material needs to be separated from something that is an indirect material. All right, so like if you think about it, if you're giving a patient a shot, that would be a direct material. An indirect material would be like, I don't know, the cleaning, the alcohol pads or swabs that you might use. That would be more of an indirect material. Right? So direct material, direct labor, and indirect costs, which is what is made up of overhead. So overhead costs, sometimes it's not easy to allocate those properly. I mean, you can, like, imagine going into a work environment and you've got to put in your time, either punch a card like we used to do way back when, or indicate the hours that you're working. So it's very easy to track direct labor. For direct material, you can see all the stuff that you bought that was material oriented. But overhead, I mean, how do you, if we're running a doctor's office and there's 8 rooms, I know my overall cost for RG&E or gas and electric or wherever you happen to be operating is, let's say you spend $200 a month. But if I were to kind of do it by departments, how much of that 200 should I be charging to Department A? How much should I be charging to Department B? So unless you've got an actual meter in every department, there's no way to know. So what companies will do is they'll estimate this cost. And so you first have to understand that there is such a thing as a cost pool, which is the cost that we're trying to allocate. And then we have to come up with what is called a cost driver. What drives this cost? So if you look over to the left in my little list here, cost pool versus cost drivers. Excuse me. The cost pool is like your overhead. Okay, this is how much I'm trying to divvy up. And how do I divvy it up? Well, it's going to be based on certain drivers. So you might say in one environment, this is very square footage oriented. So let's say you're dealing with a cleaning service, and they're coming in and they're cleaning these rooms, and let's say you are in charge of one room and someone else's department is a different room. Why are they paying less than us when it comes to cleaning? Well, because our square footage is 1,000 square feet and theirs is maybe 700 square feet. Okay? If we paid the exact same amount, then it would be kind of unfair. It would be like we were subsidized or they were subsidizing for us. Let me give you an example of not subsidizing equally. And we call this in accounting as peanut butter costing. I don't know if you've ever heard that term. You've heard of peanut butter, I'm sure. But I'm not talking about the crunchy peanut butter. I'm talking about the smooth peanut butter, all right? So if we had different departments paying equal amounts unfairly, where one department should be paying more, another department should be paying less, but let's say we kind of made it nice and even. That's what we call peanut butter costing. And peanut butter costing doesn't really give you a true barometer of what the costs truly are for each department. Let me give you an example. Let's say 3 of us go out to lunch one day, and let's say I order a salad. Let's say it costs $5. And let's say Joe in our class decides to order a more involved dinner, let's say pasta dinner, and that comes out to $20. And let's say Susie orders surf and turf, and it comes out to like $40, right? So I should be paying $5, Joe should be paying $20, and Susie should be paying $40 or whatever, okay? If Susie says while we're eating, hey, let's split the bill evenly, right? And I'm thinking, okay, I just bought a $5 lunch, and now 40 plus 20 is 60 plus 5 is 65. Oh my God, I'm going to be paying, part of her lunch for her, part of Joe's lunch. So I'm now subsidizing their lunch. So if you were to take 65 and divide it by 3, let's make it 66, right? And divide that by 3, or whatever the number might be. Is that fair to me? Is that fair that I have to pay for them in essence? So that's what peanut butter costing does. It takes this cost and it splits it equally between, these departments or individuals or whatever, when in reality, each department should be responsible for their own costs. Okay? Another example, let's say I run a JCPenney and I'm having a sale in footwear. And I realize I'm going to be understaffed, so I ask the department manager in, let's say, the clothing department, hey, can I use one of your employees for the day? Because we're having a big sale and I want to make sure that, we have enough people to serve the public. And that person says yes. But now, keep in mind, when it comes time to pay that person's salary, my department should be picking up the tab for that one day that employee worked for me. Yes, I know all of JCPenney is really paying this person's salary, but my department should now basically pay, let's say 8-hour day, 8 out of 40 hours what her paycheck normally would be, I should be picking up 8. If I don't, the other department's like, well, why is it coming out of my budget? You used her for a day. We didn't use her, so why should we pay for her salary? So when you get into departmentalization, you got to take that kind of stuff into account, okay? So product costs are those things, those costs that are associated with making the product. Period costs are basically your selling and administrative expenses. They have nothing to do with the product. Along with interest expense, income tax expense, just to name the majority of the ones that would fall under period costs. So there is a distinction between different kind of costs. Remember, in one of the videos we had, fixed costs and we had variable costs. Well, we could also set it up more traditional and have product costs and period costs. So you can set up the financial statement so many different ways when you're looking at things internally, okay? But from an external standpoint, the period costs are more along the lines of, what we did prior to this internal look at financials, okay? So I wanted to address the whole peanut butter costing, but when we get into chapter 7, which is like service line costing and pricing, we'll get into activity-based costing, and we'll talk a little bit more about, how this peanut butter costing actually works. Okay. So in looking at the remaining list that you see there, you see cost pool, cost drivers, calculation of the overhead rate, calculation of overhead applied, and calculation of job cost. So when you're calculating the overhead rate, you are involving two main categories, and that's the cost pool and the cost drivers. So just very quickly, let me show you the formula that you need to know in order to calculate the overhead rate. What you would do is you would take your budgeted overhead and you would divide that by your budgeted volume. So we would do this equation, and the result would be what we call an overhead rate. So before I continue with this, let me define for you some budgeted volume, right? By the way, I could easily use the formula cost pool that you see here, same thing as budgeted overhead, divided by cost driver. Budgeted overhead divided by budgeted volume, or pool divided by driver. So what exactly is a cost driver? What exactly is budgeted volume? Budgeted volume could be a whole lot of different things. We could say, let me go over here. So budgeted volume could be a variety of different things. It could be direct labor hours. It could be direct labor costs. It could be machine hours. It could be square footage. It could be a lot of different things. It could be number of patients, could be patient days. Square feet. There's a lot of different volumes that could be used. The secret is trying to figure out which driver, which volume is the most appropriate. So if we're doing the whole cleaning of the room kind of thing, and we go, well, if you go based on square footage, we should be paying more than the other department. But what if the smaller department has like 10 more employees than us? Could we have used number of employees as the budgeted volume? You could. There's no necessarily wrong budgeted volume. It's just which ones are better, which ones are more likely to give you a true accounting of that cost. Unless you put a meter in that room, you're not going to be able to tell exactly how much gas and electric this department is paying versus that department. Not paying, but incurring. So when it comes to the calculation of the overhead rate, it's actually very easy. You just take the budgeted overhead, which is usually given, and you divide it by the budgeted volume. So when I'm done going through all of this, I'm going to give you a little example where we'll apply all of this and ultimately, figure out the calculation of job costs. So the first thing you need to know, I'm going to highlight this in yellow. You need to know how to calculate the overhead rate, and it's just budgeted overhead divided by budgeted volume. Okay? And volume could be any of these things, but they have to tell you. It's not like you're going to be guessing, so they'll tell you what that is. So really, it's just a quick little division. For the calculation of overhead applied, what you would then do is you would take this overhead rate that we just calculated up here, and you would multiply that by the actual volume. So if you were using budgeted patient days in this original formula, then you would use actual patient days in this formula. Okay? And the result of doing this calculation is what we call overhead applied. So there are two formulas you have to learn how to utilize in this section. All right, the first one is the calculation of the overhead rate, and the second one, using the answer from the first part, you would multiply by the actual volume, and that would give you overhead applied. And that overhead applied is what will help you to actually calculate your job costs. So speaking of job costs, to calculate job costs, you would take your direct materials and then you would add your direct labor cost and then you would add your overhead applied costs. And the result of doing this calculation is your job cost. So that would be your third formula that you kind of have to know for this chapter. So you want to be able to calculate the overhead rate. Once you know the rate, you multiply that by the actual volume, and that will give you overhead applied. You will then add that applied cost to the labor and the material, and that'll give you your job cost. So let's do a little example here. So let me create a little data box. Let's say our direct material cost, I'll spell it out here, is equal to $1,000. Let's say our direct labor cost is equal to $3,000. Now don't try to figure out why is it that, I'm just making these numbers up. And then the the overhead applied, we don't know that yet. That's what we have to figure out. So let me just put a question mark in there. So next thing we want, some other data. Let's say we also know our budgeted overhead, and let's say our budgeted overhead is $100,000. Now we need this information because look, in this first formula here we need budgeted overhead, right? So let's pretend that's $100,000. And let's say the budgeted volume is made up of direct labor. DL costs. And let's say our direct labor costs is $200,000. Let's say we have another budgeted volume. Now I'm going to throw multiple budgeted volumes at us. We're going to have to figure out which one should we use. Let's say another budgeted volume is direct labor hours. And let's say the direct labor hours involved in this example are 20,000 hours. And let's go with one more. Let's say the budgeted volume, instead of direct labor costs, instead of direct labor hours, let's say it's machine hours. And let's say the machine hours turn out to be 10,000. So this is the information in our little data box. Okay, so let's say the question from this data box says something like this. So we'll say directions. Make it sound like a test kind of situation. Directions. Calculate the overhead applied and total job costs under the following three independent situations. So we're going to have to calculate overhead applied. In order to figure out overhead applied, we got to first calculate the rate. And then we got to figure out the job cost. So I could have just said calculate the job cost for these three scenarios, but you still would have to do this, and then ultimately that, right? So, and the three scenarios would be A, using direct labor costs. And to help us figure out our answer, the actual DL cost is $3,000. Independent situation B, use direct labor hours instead of direct labor costs. And actual DL hours are 400. And scenario C, instead of A, instead of B, what if we were to use machine hours? And the actual machine hours are 300. So this would be the instructions based on the data that was given in the, based on the data that was given up above it. Okay. So let's go ahead and do scenario A. In order to do scenario A, I got to go through this process. I want to calculate the budgeted overhead, and I want to divide by the budgeted volume. So let's go ahead and do that. So here's the budgeted overhead, $100,000. Okay. And I want to divide that $100,000 by the appropriate budgeted volume. And I've got three to choose from. Do I use direct labor cost, or do I use direct labor hours, or do I use machine hours? Well, in this problem, they want us to use each of them in a separate scenario. So let's go ahead and do scenario A. So scenario A involves using direct labor costs, okay, as our driver, as our volume. So remember, volume is the same thing as driver. So what's driving the cost? Is it, direct labor cost? Is it direct labor hours? Is it machine hours? Is it patient days? What is it? We're about to find out what seems to have the most impact. All right. So in scenario A, I want to take the budgeted overhead. So let's redo that. Okay. So budgeted overhead is $100,000. And the budgeted volume, since we're being asked to use direct labor costs, I'm going to be using the $200,000. So 100,000 divided by 200,000. That's going to give us a rate of 0.5 or 50%. So whenever you divide a dollar by a dollar, you are not going to get like an hourly rate kind of an answer. You're going to get a percentage or a decimal. So we got 50%. So we're saying that the overhead rate we want to use to help us calculate our overhead is going to be 50% of whatever the labor is. Okay. So now what we want to do is we now want to do this second part, which we want to take the rate and we want to multiply it by the actual volume. Okay, so why don't I just continue that to the right? Multiply by the actual volume. And the actual volume, if you remember, they told us right down here in the directions, what if the actual volume was $3,000? $3,000. So take the rate, multiply by the actual volume, and that would give us our overhead applied. Well, so what's half of $3,000? It would be $1,500. So we're saying if we use direct labor cost, we're saying the overhead cost is about $1,500. It's half whatever the labor is. So to calculate the total cost of the job, we got a direct material costs, direct labor costs, and now we've got our overhead applied costs. So direct labor was given, if you remember, $1,000. Direct labor was given $3,000, and we just calculated the overhead applied, $1,500. So if we add those all together, total costs gives us $5,500. So 5,500 is the answer to letter A. I'm not saying that, that is definitely the appropriate answer. I mean, mathematically, we did everything right, so it is the right answer, but I'm saying that what if direct labor cost wasn't the appropriate driver to use? What if direct labor has nothing to do with the activity that's being done? So does it match up with the, the cost pool? Is it the right driver for the pool, right? And there's a couple of pages in there in your textbook that kind of address something like that. And I'm trying to see if I can find it here. So if you happen to have your textbook handy, page 205, look at the first paragraph on page 205. I'll read it to you in case you don't have the book or you're, not in this course, but you're listening to how to calculate rates. For example, right at the top of page 205, for example, the total inpatient overhead costs of a hospital might be divided by the total inpatient days. Okay, so inpatient costs divided by inpatient days. Given an allocation rate of so many dollars per patient day, which is called a per diem overhead rate. So if a hospital had 72,000 patient days in 2015 and its total inpatient overhead costs were 36 million, the overhead rate would be $500 per patient day. So in other words, they took 36 million, which would be like our budgeted overhead, and divided by 72,000, which would be like our driver, our volume. So with the example in the book, they went 36 million divided by 72,000 patient days, and they came up with an overhead rate of $500 per patient day. But check this out. Regardless of the type of patients treated within inpatient services, adult versus child, trauma versus illness, acute versus critical care, and so on, the $500 per diem allocation rate would be applied to determine the total indirect cost allocation for that department. So we're coming up with this 500, but is it really fair? Are we going to run into like that peanut butter costing thing that I was talking about? So is using patient days the true accurate measure of the overhead cost? That's what I'm getting at, right? So mathematically, we did this 5,500 correctly, but is it the right, is it right for us to use direct labor cost as the denominator? Maybe we should be using direct labor hours or machine hours or patient days or square footage or who knows, okay? I like the next paragraph. It says, however, it is clear that not all overhead costs are tied to the number of patient days. And that's my point. Okay. It says, for example, overhead costs associated with admission, discharge, and billing are typically not related to the number of patient days, but to the number of admissions. All right. So maybe the true answer to this is that maybe we should have more than one overhead rate. Maybe we should have maybe we have more than one cost pool. And that's where the next chapter is going to come into play. When we get to chapter 7 and we look at activity-based costing, we'll delve into that a little bit deeper. Okay? So we want to look at fairness, and later on in on the page near the bottom, second to last paragraph, it says, effective cost drivers possess two important characteristics. Number one, which is the less important of the two, fairness. That is, does the cost driver chosen result in the allocation that is fair to the patient services department? The second, and perhaps more important characteristic, is cost control. That is, does the cost driver chosen create incentives for departments to use less of that overhead service? So, there's things that you got to take into account that seem to kind of influence what's the best way to go. Anyways, so let's do another example. Let's now do letter B. Right? And I'm just going to copy some of this information. So I don't have to rewrite everything. Actually, I'm going to copy the whole thing, and I'll just make changes as we go. So in scenario B, the budgeted overhead, again, doesn't change. That's 100,000. So let me put that in yellow. because that's kind of fixed among all the three scenarios. But this time we want to use direct labor hours, number of hours of labor, not the labor cost. And the number of hours, according to our original budgeted data, okay, let me actually call this budgeted data. Well, no, I've got it right here. All right, so let me highlight this though. Put this in its own separate little box and its own separate little color. Okay, and now let me put that in yellow. So the stuff that's in blue and this yellow here, that's our budgeted information. So when I say budgeted overhead divided by budgeted volume, I'm looking at this budget. Let me put it all in yellow. To heck with it. All right, so there's all our budgeted data. So now budgeted overhead divided by budgeted volume. So 100,000 is our budgeted overhead. That's going to be the same numerator in all three of these situations. But this time, I want to use a different volume, a different driver. Maybe we think hours has more to do with overhead than dollars. So we'll put 20,000 in here. And if we go 100,000, whoops, that's not, hang on, I gotta fix that. This 20,000 as in, it keeps wanting to put a dollar sign, so let me fix that in general. So 100,000 divided by 20,000 hours, that's going to give us $5 per hour. $5 per direct labor hour to be more specific. Okay. The actual direct labor hours are 400. So if I go 400, except that again is supposed to be non-currency. There we go. So 400 hours multiplied by $5 per hour, $2,000. So remember when we did it the first way, we came up with 1,500 as our answer for overhead. Using a different driver, we now have $2,000 representing our overhead. So let me put the 1,000 in there. Let me put the 3,000 in there. So now under this scenario, we're saying the total cost of the job is actually $6,000, not 5,500. Interesting, huh? So depending on what technique you use, that's going to impact your dollar value for the cost of the job. Okay. All right, let's do scenario C. So scenario C says use machine hours instead of direct labor hours. So the machine hours budgeted for was 10,000. So 100,000 divided by 10,000 hours gives us $10 per machine hour. The number of machine hours is 300. So 100,000, notice 100,000 has been in the numerator every time. Oh shoot, I was updating the wrong thing, hang on. There we go. All right, so machine hours, according to the data, was 10,000. Giving us the 10. We have 300 actual machine hours right here. So $10 per machine hour times 300 actual machine hours gives us $3,000 for that cost. And if I input my original $1,000 for material, $3,000 for the labor, and now my overhead applied cost ends up being the same as my direct labor this time. So total cost is $7,000. Okay, so notice when we use, now it doesn't always go up like this. It could have gone down. It's just a coincidence that each answer provided a higher result. So don't think that's going to happen every time. But bottom line is, depending on which driver you used, that impacted, not only the overhead cost, but the total cost of the job. What didn't change in any of this? Notice in none of these scenarios, my overhead costs did not change. They all stayed the same. What changed was the denominator, the driver. Down in the cost of the job, your material and labor was the same in all three scenarios. And what was altered was the overhead. Okay? So in looking over your chapter 6, that seems to be half of your chapter. And then I'm going to make a separate video on the other half, which is departmentalization. Okay? So hopefully this helps. As usual, do all the questions that are at the end of the chapter. I will upload the solutions to all of the questions. So, you try them and then you'll see the answers directly. Okay, I hope this was helpful, and the other video is going to be coming very soon. All right, talk to you later. Bye-bye.